now we're shifting gears to economics. Ms. Hannah Baker is our state specialized agent in beef and forage economics. She works closely with Florida cattle producers, teaching them strategies for economically efficient herd and forage management. Please join me in welcoming Hannah as she shares an overview of the 2025 cattle market.
Thank you, Allie, for that introduction. I can adjust that. Okay. Like she said, my name's Hannah Baker. I started here at the center back in June 2023, so this is my very first field day, so I'm very excited to be here with all of you this morning. Like she said, I am going to present and just kind of give an overview of what's going on in the cattle market. As we all know, cattle prices are more than favorable right now and have been for the past little over a year. So I'm just kind of tell the story of what's going on in the cattle industry. So y'all just bear with me. And I'm sure, I think everyone got a book when you checked in this morning, so I'm kind of going to follow that guide of the slides I have in there. So if you would like to follow along with me, please feel free to do that. So I'm just going to kind of start off by talking about some things that we left in 2024 and then some thoughts as we have gone into 2025 and throughout the rest of this year. So what we do know is that we're at the bottom of our current cattle cycle. So typically cycles range between 9 and 14 years. This year, 2025, will be year 11 of the current cycle that we are in. And because of low inventory, and it's actually the lowest inventory we've seen in 74 years when you look back at the data, because of that, that is what is attributing to these high prices. You have low supply, consistent demand, that's going to affect your prices. So that kind of tells that story. And on top of that, we have not seen any really hard, significant signs of herd rebuilding through heifer retention. And just this past year, we've kind of seen the cow culling slow a little bit. So I'm going to talk a little bit about that a little bit later on, but that kind of sets the stage for that. So those are the things, so some of the things that we do know. Other things that we don't know going into this year is, are we at the very bottom? So we are at the bottom of this cycle in terms of inventory levels and high prices, but are we at the point where we're still liquidating and getting rid of cows and not really in that heifer retention phase? Could we still be liquidating this year going into 2026? And so USDA last year announced that they were discontinuing the July inventory report, but then recently this year they have announced they are reinstating that. So us as economists are pretty excited about that because that report really helps us get an idea mid-year of where we're at in terms of cattle numbers. So be on the lookout for that report, and that'll kind of help us tell that story of, are we stabilizing this year or are we still liquidating? And then on top of that, so because we haven't really started expanding and rebuilding, how long are these prices going to last, and what is kind of the story behind that? So I'm going to talk a little bit about all of that throughout this presentation. So if you flip to the next page, so that was kind of the market side of things. And in my program, it's kind of split into two bigger programs. So one's more about the market, and one is more about economical management strategies. And as we know, those two things go hand in hand. How can we use the information we know about the market to influence how we manage our cattle? So I definitely wanted to just kind of talk about some things on the management side. So some things we know in terms of cattle management during this cycle is that input prices are high. They're higher than they've been in a while. Some things have gone down since 2020 when we were during COVID and the Russia-Ukraine war, and all that really affected our input prices. So things have come down a little bit since then, but they're still really not where we would like them to be in terms of profitable management. But cattle prices, again, are also high across the board. Steers, heifers, cull cows, bulls, everything's looking good right now. So that's really encouraging that the sales of those female cattle, those heifers and cull cows, rather than retaining them and rebuilding. So with those two combinations, profits are more than likely larger than they've been in previous years, but because of the higher inputs, they may not be as high as we would like to see them. So it's really important to still continue managing our input costs and exploring risk management strategies and maybe altering things to take advantage of this current market. So some things we don't know is, will input prices increase or decrease in 2025? There's a lot of uncertainty, as we all are aware of the tariff talk going on and the trade war currently. So there's just some uncertainty there of what things look like going into this year. So again, it's just really important to explore some risk management strategies to help stay ahead of that. Okay, so those two slides just kind of set the scene for what we're going to talk about today. I have prices. We're going to talk about prices because that's what everybody wants to hear about, but we're going to talk about that a little towards the end because I really want to paint the picture of what's going on in the industry as a whole to explain why we're seeing the prices that we're seeing. So we'll start off with inventory, our cattle numbers. So in that chart there, you'll see I've broken it down on a national level and then also on a state level of Florida. So currently, Florida ranks number 10 in beef cattle production. We were 9 last year, so we've dropped 1 rank, which is not a huge deal, and it's mostly because a couple other states, like Kentucky, they saw some increases in their cattle numbers, which we did too. We saw an increase in beef cow numbers of about 3,000 head. So not a huge increase, but that kind of tells the story that maybe in Florida, some producers are thinking about stabilizing and transitioning from liquidating to rebuilding. So I won't read just all of these numbers. I'll kind of keep it Florida specific. So we have 865,000 head of beef cattle. Like I said, that's about a 0.3 increase from last year. And then when you consider all beef and dairy cattle, we have about 1.5 million head. It's the smallest cow herd in Florida since 1961, and then the smallest beef cow herd since 1964. And then, so one thing I wanted to highlight, the beef cow herd compared to our last inventory low that we saw in 2014. On a national level, we're about 1 million head smaller. So that kind of tells you that this cycle is different than the last time we were that low. And then relating that to Florida, we're about 40,000 head smaller. So that just kind of tells the story of we're smaller than we probably intended to be just because of that prolonged drought in 2022 and 2023 that affected the whole country, and then on top of that, the higher input cost just was not a good combination for producers to hold on to those cattle just because it was expensive to compensate for limited forage. So that's really the main attribution to why we're seeing these low cattle inventory numbers. And then talking about drought, so we saw that back in 2022 and 2023, and we've gotten some relief since then. But now that we've transitioned out of a La Nina phase, going into El Nino, it's predicted that this year is going to be a more neutral year. So we're still going to probably see some persistent drought, specifically in the southern plains and out west. So that's definitely going to play a role in how intense producers are going to start rebuilding or retaining, or if they will at all. So that will definitely be something to keep an eye on out west, but also here. So drought will definitely play a big role in how fast and when we start rebuilding. Okay, moving on just a little bit more about inventory, specifically about heifers. So heifers and female cattle, that's our herd. Like we like selling steers, but without the females, we don't have the steers to sell. So this heifer market and the female market is really what we watch to track if we're rebuilding and expanding. So in this graph, I know it's kind of small just because we had to fit all this in one booklet, but the 2 red circles that are circling those 2 parts on the graph, I just wanted to compare those. So the first circle, more towards the left in the center of the graph, is showing that last cattle cycle where we were at our low inventory levels and high prices. You can see in the years of about 2011 and 2012 and 2013, we were banking replacement heifers. So when the time came to expand in 2015, we were ready because we had that heifer inventory to work with. But then if you look further down the graph into where we are now into 2023, 2024, you can see going into this year, we didn't keep any replacement heifers. It's the smallest pool of replacement heifers since 1949. And so you can see that difference, that even if we wanted to start expanding, it's going to take longer this cycle because we just don't have the heifer inventory. So in the latest report, the number of bred replacement heifers that we have on a national level is just under 3 million. And so that number is pretty much fixed. We can't go back to 2024 and breed more heifers. So one thing that we can watch this year and won't really know until the next inventory report next January is what we refer to as impulse breeding. So maybe producers who retain some heifers that they weren't really planning to retain and they breed them. So that can affect how fast the rate of expansion as well. So that'll be something we'll be looking forward in the coming years to see what producers do this year. Yeah, so that's the kind of the story about heifers. That, again, that number of bred replacement heifers that we're going into this year with is pretty much fixed. So this year, the big focus is going to be on cow culling, and I'm going to talk a little bit more number-wise later on about that. But it's really going to rely on cow culling this year? Are we going to slow even more than we did last year, and how is that going to affect our cow numbers? Okay, and then I think this is my last slide on inventory. Yep. So without the cattle numbers, obviously that affects how many cattle are going into feedlot and those packing plants and then turning into high quality beef products. So in this graph, it just shows from 1995 to the forecast for this year. You can see that feeder cattle supplies, which are the cattle going into the feedlots, is down. And I believe, I don't have the exact date on here, but I believe it's the lowest supply of feeder cattle since like the 1950s. So again, that number, we're really low. And so that's going to affect the cattle going into the feedlot and then turning into beef production. So that's ultimately going to affect beef production. But I am going to talk a little bit more about how we've offset that in the past couple of years a little later on. So what does all of this indicate? That culling did slow this past year, but significant heifer retention has not started. So that'll be something we'll be on the lookout for. Stabilizing may be the theme of 2025. We may not be ready to expand just yet, but there may be some thoughts of let's kind of stay where we're at and then start thinking about rebuilding. But again, drought's going to be a big player in that. And then when we do start expanding, feeder cattle supplies are going to decrease even further because those heifers that are now flooding the market that we're getting rid of and not retaining will eventually start being retained, and so that means less feeder cattle entering the market, and that also is going to affect higher prices. And then I have a smaller note on here that I'm also going to talk about a little bit later is consumer demand also plays a significant role. We've had some record level demand over the last year, really seeing consumers want and desire that high quality beef product, and they're willing to pay for it. So that's definitely going to be a continuous driver. Okay, so talking specifically about cattle on feed, I just have a couple slides on this. So another thing that we look at is heifers on feed, on these cattle on feed reports that come out each month. And quarterly, they're broken down by steers and heifers, and so we can look at how many steers are on feed and how many heifers are on feed. And so that percentage kind of gives us an indication of how many heifers, are we sending more heifers to the feedlots, or are we keeping them in our pastures? So as of the last quarterly report in January of 2025, there was 38.7% of cattle in the feedlot that were heifers. So just to kind of put this in perspective, the last time we expanded, we saw that number drop to about 30 to 34%. So while this number has decreased since last January when we saw it at 40%, it really has not dropped enough to really indicate that these heifers are staying on our operations rather than going into feedlots. And the next quarterly release of this will be actually next Friday, and I'll probably do, if you keep up with the monthly reports that I put out, I will probably do a segment on that, so be on the lookout for that, and that'll kind of give us an indication of where we are in this first quarter. And then just talking a little bit more about cattle on feed. So we had less feeder cattle supplies, and we really had less non-fed beef production, which is the cull cows and our cull bulls that are going to these packing plants. So the overall decline in cattle slaughter last year was down 3%, but with cheaper corn costs and grain costs, feedlot operators were able to hold on to these cattle longer, these steers and heifers, and feed them longer to achieve higher weights to sell them at. So because of that, those heavier carcass weights, which were record-breaking last year, helped to offset the overall decline in cattle slaughter. So we can see from this graph, you can see it's well above the 5-year average, and we're still up there higher than we were last year. So I was looking at the numbers yesterday. The steer 2024 average dressed weight was 931 pounds. The 2025 average so far is 952 pounds. So we're already on track. It's only 2 months of data, but it just kind of tells the story that we're still feeding those cattle long to try and achieve those higher weights. So one point I wanted to make was there's two kind of sides we can see from this. One is, will we continue to see higher or heavier weights in 2025 to continue meeting that consumer demand, or will packers eventually have to pull up lighter cattle to meet demand? So they got to fill their packing plants, so they're going to pull them up at certain weights, or feedlots are they going to be able to keep feeding them? I think we're going to see mostly this year those feedlots continue to feed those cattle out longer, especially if grain prices stay where they are for them. But I think eventually we may see the pulling up of lighter cattle as we have to meet demand, and that the limited supplies catches up with us. And we can kind of look at data to tell that story as well. So if you look back at average steer dressed weights over the years, you can kind of see they fluctuate and they kind of go with the inventory levels. So it kind of tells the same story of feedlots will feed longer to achieve those higher weights, and then it comes back down when inventory kind of recovers. But we've steadily been increasing weight since 1981, when the average steer dress weight was 708 pounds. So we've steadily been increasing and improving how we feed cattle and are able to meet consumer demand for beef products. Okay, I think that's all I wanted to say about that. Yep, okay. So moving on to beef production, because that's where those cattle are going, right? That's the whole point of why we raise cattle, is so that we can have high-quality beef products. So from this graph, we can see that we have made tremendous strides as an industry in how we produce beef with less cattle. So this graph, that dotted line, is showing inventory levels, and you can see in the last few years, 2019 through now, that beef production has increased tremendously, and we've got less cattle to do it with. So in 2024, the total beef production was 26.9 billion pounds, which was actually slightly above the beef production produced in 2023, which is crazy to think about because we had less cattle going into 2024, but we were able to produce the same amount of beef, and that attributes also to those heavier carcass weights. So pretty cool story there. The 2025 forecast is just under that at 26.6 billion pounds. And that was as of March, but I checked it yesterday, and as of April 10th, that report, it's gone up a little bit to 26.7 billion pounds. So, and they are also attributing that to continued heavier carcass weights. So that'll be something we watch this year. Let's see. Sorry, I have notes in here because I wanted to make sure. We had to have these books printed like a month ago, so I wanted to make sure I did include some updated information for y'all. So each cyclical peak, so inventory levels, has been lower than the last since 1975. So every time we've peaked with inventory levels, it's been lower. So that again just tells the story that we've been able to figure out how to produce higher quality beef and more of it with less cattle. Okay, but the extra pounds on the other side of that, the extra pounds that we're seeing in those carcass weights can only offset our tight supplies for so long. Eventually that tight supply is going to catch up with us, and it will more than likely affect beef prices that we already are seeing at high record level prices for beef. We will likely see those prices go up even further as we get into, as these tight supplies catch up with us. So that's just something to think about. But going into that, talking about high prices, we've had record high prices, but we've had record consumer demand as well. So CattleFax reported at NCBA that consumer demand for choice or higher grading beef is up 70 to 80% since 1998, despite high prices. So that just tells the story that consumers are willing to pay for that high quality beef product, even when we're at record high prices. So in 2024, the average retail price for all fresh beef products was $8.23 a pound. And then as of March 2025, we're still seeing those prices at the higher level. March 2025 prices were about $8.42. And then the 2025 average so far is $8.29. So we're still at that high price level. But if you look at the graph on the right side that talks about beef price quantity relationship, I know that graph kind of looks confusing, so there's a lot of numbers everywhere, but I'm gonna break it down. So the bottom line is pounds per capita. So that is the consumption per person, what they're consuming of beef. And then the y-axis is the price per pound. And then all those little numbers within the graph are the years. So what I want you to do is just look at the left side where it says 14 and 15, and then where you see like 2023 and 2024. So right there we can see that in 2014 and 15, consumers were consuming less beef when prices were high, but now we're consuming more beef when prices are still at that level and even higher. So that I wanted to include that graph just to tell that story of, again, consumers are willing to pay for that high quality product that producers have adapted over the years and worked hard to produce. So moving on, I have one more slide about consumer demand. So I wanted to make this point. Consumption and demand are not the same thing. So consumer demand could stay relatively the same within this year and the next few years, but like I said, those tight supplies are eventually going to catch up to us. So we may see a drop in consumption when we're looking at data, but that may just mean the beef product isn't there for them to consume. They still want it, but we just don't have enough of it. So if you see graphs coming out, in the next year, 2 years or so, and you see that demand or beef consumption dropping, don't necessarily take that at face value that, oh, consumers aren't buying beef anymore. It could just be that we just don't have the supplies to give it to them. So that's why I included this beef consumption graph and the demand index graph to show you that while consumption may be forecast to drop, that demand we've seen, it's 28% higher than it was 25 years ago. So yes, that was my last slide about consumer demand. So we'll move on from that. So we talked about cattle on feed, and then those cattle in the feedlots go to the slaughterhouses. And so we're going to talk a little bit about cattle slaughter. So overall cow slaughter, so beef and dairy, it declined about 15% in 2024, and then beef cow slaughter declined about a little less than 20% in 2024. So looking at that at face value, that looks like, oh, we stopped culling tremendously throughout last year. Well, when you look at it in terms of how many beef cows that we have, when you divide that and do that math, and you get your cow culling rate, so the amount of cattle that we're slaughtering compared to how many we actually have, that percent is about 10.1% leaving 2024. And during our last expansion, just for comparison, that number was at 9 or below. So again, just like we talked about with the heifer numbers on feed, this is something we can watch to see how much culling has slowed and if we're really getting into that expansion phase. And then just another point to drive that home, heifer slaughter is about 31.5% of all slaughter as of February, the latest report. And during the last expansion, that number was in the mid-20s. So again, those are just some things that we can watch, some indicators of how fast we're expanding. Okay, so now we're going to get into what everybody wants to talk about, which is these high prices. So I have this first graph, which is Florida specific for steer calves of 450 to 500 pound weight. So steer calf prices in Florida are almost 9% higher year over year, and that was comparing March to March of 2024. The average 2024 price for this weight class of cattle was just under $300 per hundredweight, and the average 2025 price so far is about $340 per hundredweight. Now, we are in that first quarter of the year where you're going to see those seasonality price effects where prices are higher in the spring. So obviously the more realistic prediction for feeder cattle prices is about $274 per hundredweight. And there is a typo on this. This is my fault. The WASD 2025 feeder cattle price projections, that should say fed. So that's for fed cattle. So March 2024, the average was about $187 per hundredweight, and going into 2025, it's been raised to about $200 per hundredweight. So I have these prices in here just for those of you who may retain cattle ownership throughout the feedlot phase, and you were curious about the heavier weight feeder steers and the slaughter steer prices. So with all of these high price forecasts, there's a lot of variability as well in the market. So I've heard it talked about as there's a lot of air up underneath this. So it's really important to explore risk management strategies and take advantage of high prices when you can. An example of that, with all of this trade talk going on, there's a lot of uncertainty. Again, I mentioned that earlier. So example of that was we saw on April 2nd when the tariff announcement came out on all the other countries, the feeder cattle market really dipped down. So there's just a lot of uncertainty with high prices, and then on top of everything going on politically, just really important to keep a watch and explore your risk management strategies. Okay, and then heifer prices, just want to talk about those a little bit. Those have also increased. Comparing February to February of last year, they've increased almost $43 per hundredweight for that same weight class of 450 to 500 pounds. And the value is expected to keep increasing as we approach expansion for all female cattle. So heifers, replacement heifers, bred cows, cull cows, any type of female, just because as those females are retained, it's going to lower the supply that we have for the feeder cattle market, and they're going to be more valuable. So on that note, I wanted to talk about a little bit when we do get into that expansion phase. So not everyone will be able to partake in the expansion phase just because female cattle are expensive. And not everybody is going to be able, when they pencil it out, to really take that leap and invest in those cattle. But those who can should really start thinking about it now and making those penciled out decisions. You may have to subsidize that cow for a little while, meaning you pay, you got to put a little bit more into her than she's giving you in the short term. But what is that long-term average going to be? Is she going to be able to pay herself off in a reasonable amount of time to fit your operation? So one strategy that I myself and some other economists have talked about is it's worth looking at your long-term averages of what you've spent money on when you're buying replacement heifers or retaining replacements, what's your long-term average price, and maybe you can partake in rebuilding and expanding by buying some replacement, but maybe you don't buy as many that you have in the past. You're still spending the same amount of money, but not buying as many cattle, and maybe slowly building that way until we see these prices decline. So that's just kind of one way to think about it. And then talking about some cull cow prices, slaughter cow prices. So you've got your utility cows and then your cutter cow prices. We've also seen increases in those just because of, again, the consumer demand. We're a ground beef eating country, and so we just have gotten rid and liquidated a lot of our cull cows, and so they're really valuable to try and also meet that ground beef demand. So those prices are higher. I like to refer to cull cows as a secret weapon because, yes, we want to cull cows, we want to cull the opens, just kind of like a routine annual thing. But especially in this market, it may be worthwhile to consider some different management strategies to try and increase her value even more. Maybe improving her body condition score before you load her on the truck, or maybe even trying to breed her if she's already in a good condition score. So those are just some thoughts to think about. And that's what this kind of next slide is really about, so I won't spend too much time on it. That's just prices in Florida showing the difference between those cutter cows and utility cows, that there is some opportunity there to, if you can, invest in her to increase that body condition score and increase her value. All right, and then just wrapping this up, talking about returns. We talked a little bit about cost and then the high prices, so what does all that mean for profitability? So the forecast currently, as of March 12th, is returns to cash cost and pasture rent, so that does not include fixed costs like depreciation, equipment, land payment, and all that. So that's important to still consider. But in returns to cash costs are forecasted to be about $500 per cow, a little bit more than that. So the outlook is really good for cow-calf producers over the next several years with these record high prices. This estimate for returns is similar to the returns we saw in 2014 when production costs were about 20% lower. So again, that kind of reiterates the point I made earlier in the presentation of profits are good, but they are probably not as good as we would like to see them because of higher input prices. But the upside to that is that we haven't started that expansion phase yet. So it's expected that we have not seen the peak in cattle prices yet. So even kind of when we're seeing this same level we saw back in 2014, it's likely we'll look forward to higher profits in these next couple of years. So, such as some take-home messages from all that, because I know I covered a lot. So, predicted margins for cow-calf producers are good due to tight supplies and high prices, which will hopefully soon encourage and incentivize rebuilding. Those who can rebuild should take advantage of that and start penciling that out to see where they are as an operation. And expansion is expected to happen at a slower rate than the last cycle, so that's why we're expecting these prices to last a little bit longer, because of low inventory, especially on the heifer side, input cost, and forage availability. Consumer demand and drought conditions will be key drivers of cattle prices. We want to see that consumer demand stay consistent that it has been. And then with high prices comes increased market volatility. Again, so just we want to explore our risk management strategies. And then just kind of a really key take-home point is investments and marketing strategies should be well thought out using accurate records. You don't know how to improve your operation if you can't go back and look at what worked in the past and what didn't work. So just some points there is just because we may have a little extra money right now with these profits doesn't mean we necessarily have to spend it all. But on the other side of that, not reviewing your current management strategies to try and make alterations to take advantage of this market would be a missed opportunity. So with all that, I just wanted to give a positive outlook that it's looking good for cow-calf producers over the next couple of years. And I'm excited to be a part of this industry. And as always, you can please contact me, email me, call me with any questions. Thank you.